On February 17th, Ray Dalio posted 2 words on social media. It's official, no explanation, no context, just those 2 words. And within hours, financial media around the world was trying to figure out what exactly he meant. He answered that question the next day. He said the world order, the system governing global trade, finance, and security that has been in place since 1945 has broken down. Not is breaking down, has broken down, past tense, done. Now here's where it gets interesting. Because at the exact same time Dalio was posting those 2 words, his fund had already filed a document with the SEC that shows exactly how seriously he takes that declaration. $27.4 billion repositioned, 191 brand new positions, 165 completely exited in a single quarter. When someone who manages $27.4 billion says the world order is broken down, the natural question is, okay, but what does that actually mean for the money? Today we go inside that filing. 5 moves, the reasoning behind each one, and the one number that changes everything about how you should be measuring your own portfolio. That number is negative 28%. The S&P 500 returned 18% last year. Most investors saw that and felt good. 18% is a strong year, but Dalio looked at the same number and saw something completely different. He ran it through a different calculator, not in dollars, but in a different unit of measurement entirely. And when he did, that 18% became negative 28%. Same index, same year, same portfolio, different math. By the end of this video, you will understand exactly how that calculation works, why Dalio says it is the most important number most investors never think about, and how every single move in his portfolio connects back to it. Let's open it up. To understand why Dalio made these moves, you first need to understand the model he has been building for 40 years. He calls it the big cycle, and the concept is straightforward, even if the implications are enormous. Empires rise and fall in recognizable patterns. Not identical ones, but patterns that rhyme closely enough to be useful. The Dutch Empire in the 1600s, the British Empire through the 1900s, the American century beginning in 1945. Each followed a similar arc driven by the same 5 forces: debt, political division, geopolitical competition, natural pressures, and technology. What his research found after mapping these cycles across 5 centuries of history is that the end stages are almost always the same. Debt becomes unsustainable. The currency that powered the empire loses its value quietly, then suddenly. New powers challenge the old one. And through all of it, the people who understood the pattern built wealth. The people who did not lost what they had built. His conclusion today is that the United States is approximately 85% through its current cycle. Not at the beginning of a problem, near the end of one, and 4 out of his 5 forces are deteriorating simultaneously right now. Debt, political division, geopolitical tension, and climate pressures, all moving in the wrong direction at the same time. Technology is the only one pointing upward. That is the backdrop. Now here is the timeline of how his public warnings escalated, because understanding this timeline is what makes the portfolio moves make sense. In March of 2025, speaking to Bloomberg, he compared the United States debt situation to a slow-motion heart attack. He estimated roughly 3 years before the consequences became impossible to ignore. In April, on national television, he said he was worried about something worse than a recession. In September, on a podcast, he used the phrase, very, very dark times. In January at Davos, he said the rule-based world order is simply gone. And then on February 17, 2 words. It's official. He placed the United States in what he calls stage 6 of the big cycle, the final stage. The one his historical research consistently associates with the kind of disruption that rewrites the rules entirely. He had never categorized America that way before. The numbers underneath that declaration are not abstract. Total United States debt now exceeds $38 trillion at the federal level. The government spends over $1 trillion annually on interest payments alone, more than the entire military budget for the first time in history. The Congressional Budget Office projects another $26 trillion in additional debt over the next decade. Dalio's own words on this are worth repeating slowly. He has said that his grandchildren, not yet born, will be paying off this debt in devalued dollars, not defaulted, devalued. The government will keep paying. It will just pay in a currency that buys less every year. That single sentence is the entire thesis behind everything that follows. Before we walk through the 5 moves, one important caveat. This type of quarterly SEC filing only shows long equity positions in United States stocks. It does not reveal short positions, bond trades, currency bets, or derivatives. You are seeing one layer of a much more complex machine. Keep that in mind. The moves visible in the filing are significant. But what is not visible may be even more so. Now, 5 moves that reveal exactly how Dalio is positioned for what he says is already here. Move number 5 is the one that genuinely shocked people who had followed Dalio for years, because it did not just represent a financial decision. It represented the reversal of a 20-year conviction. For 2 decades, Dalio was one of the most consistently optimistic Western voices on China. His fund was among the very first foreign firms ever allowed to operate inside the country. He wrote and spoke extensively about China as a generational investment opportunity. In early 2025, Bridgewater dramatically increased its Alibaba position by $2.7 billion, making it their single largest stock holding in the world. 1 quarter later, it was entirely gone. Not just Alibaba. Every Chinese stock in the portfolio, Alibaba, JD, PDD, and others, roughly $1.5 billion liquidated in a single quarter. Their emerging markets exposure was cut by 93%. By the end of the year, China exposure in the portfolio was effectively zero. What happened between those 2 decisions? 2 things collided at once. 50% tariffs on Chinese imports went into effect, fundamentally changing the risk mathematics for any company operating between the 2 countries. And Dalio began publicly warning about what he describes as a capital war, a situation where governments start using trade, finance, and technology as weapons against each other, rather than as tools of mutual growth. His conclusion was direct. When governments weaponize economic relationships, even genuinely strong businesses become collateral damage. The quality of the company stops mattering if the asset sits in the wrong jurisdiction at the wrong moment in history. He walked away from a conviction he had held for 20 years. Think about what it costs financially and personally to reverse a position that publicly and that completely. Then think about why he made that decision anyway. That tells you something about how seriously he takes what is coming. Which brings us to move number 4. And this one deserves a moment because it looks on the surface like a direct contradiction. In 2023, Dalio publicly stated that artificial intelligence was in the early stages of a bubble. The hype was running ahead of reality. Valuations had disconnected from fundamentals. He was cautious. Then, in 2025, he put more money into artificial intelligence companies than he had before. That sounds like a man who changed his mind, but look precisely at what he sold and what he bought, and the logic becomes almost elegant. What Bridgewater sold, Alphabet cut by 40%, over $300 million removed. Meta reduced by 46%. Microsoft trimmed. In total, over $460 million pulled from companies that package artificial intelligence for consumers and businesses. Bottomies whose valuations are built on the assumption that everything goes perfectly, forever, without disruption. What they bought, Micron, the memory chip manufacturer, went from nearly zero to $253 million. Oracle Cloud Infrastructure up 361%. Salesforce Enterprise Software up 285%. NVIDIA up 54% to $720 million. He did not leave artificial intelligence. He moved underneath it. And this pattern is not new. Every major technological wave in recorded history follows the same script. The story companies capture the imagination first. Their valuations inflate beyond any rational justification. Then they collapse, but the physical infrastructure they depended on, that survives. Railroad companies went bankrupt by the thousands in the 1800s. But the railroads themselves kept running for over a century. Fiber optic companies vanished entirely in the dot-com crash, but the cables they laid are still carrying internet traffic to this day. Dalio is making a specific bet. The hype layer of artificial intelligence breaks first. The infrastructure layer, the chips, the memory, the cloud, survives longer. If you have been watching technology valuations lately and wondering how much is real and how much is story, leave a comment below and tell us where you stand. Because this question is going to matter enormously over the next year or two when we read every single response. Move number 3 is about gold. But the specific way Bridgewater is holding it reveals a distinction that most investors overlooked, and it changes the math significantly. In early 2025, they built a $318 million position in a gold exchange-traded fund. Simple, liquid, one-to-one exposure to the metal price. Then they sold all of it, and then a few months later they came back into gold, but differently. They nearly sextupled their position in Newmont, the world's largest gold mining company. Why does that distinction matter? A gold fund gives you exactly what it says. Gold goes up 10%. Your fund goes up 10%. Clean and simple. A gold miner operates on different economics. The mining company has fixed costs, equipment, labor, operations. When the gold price rises, those costs stay exactly where they are. But revenue expands dramatically. If gold rises 10%, a well-run mining company might see its profits expand by 20 or 30%. You get leverage on the same underlying conviction. And the conviction has been validated in a serious way. Gold returned 65% in 2025, its best performance in 46 years. It set 53 separate price records in a single year. Central banks globally purchased 8,263 tons of it. Not retail investors, central banks. The institutions responsible for managing national currencies were moving out of paper and into metal. At Davos in January, Dalio said something that deserves to be heard carefully. He said, "Do not think of gold as a metal, think of it as money." The kind of money that central banks themselves treat as money. That reframing is the whole argument in one sentence. If gold is money, then what sits in your brokerage account is not money, it is credit. And credit can be printed in any quantity the government decides it needs. Gold cannot. That asymmetry is exactly what his portfolio is built around. Move number 2 looks bullish on first reading, and this is where the filing is easy to misinterpret. The 2 largest positions in Bridgewater's disclosed portfolio are both S&P 500 exchange-traded funds. SPY at $3 billion and IVV at $2.8 billion, nearly $6 billion combined. If you see that number and conclude that Dalio is simply optimistic about United States stocks, you are reading it the way most financial headlines read it. The Bridgewater runs a strategy called risk parity. The goal is to balance risk across different asset classes, not simply distribute capital based on conviction. These index positions are baseline exposure, the anchor that keeps the portfolio connected to broad market performance while everything else, the short positions, the currency trades, the bond bets that never appear in any public filing, gets constructed on top of that foundation. Think of it as a building. The $6 billion in index funds is the foundation. The structure above it, the hedges, the derivatives, the positions you will never see in a quarterly disclosure, that is the rest of the building. You can examine the foundation. You cannot see the walls and the roof. Keep that in mind the next time a headline tells you Dalio is bullish on American stocks. And now, move number 1. This is not a stock position. It is not a trade. It is a lens. And this is the part of the video that started everything. That negative 28%, we opened this video with that number and said it would change how you measure every investment you own. Here is exactly where it comes from. The S&P 500 returned 18% in 2025. Every financial publication reported this. Most investors who owned index funds felt good about the year. But Dalio's question is one that almost no one asks. What currency are you measuring that return in? Everyone assumes the answer is obvious. Dollars. But the dollar itself was moving in 2025. Gold gained 65% that year. So if you measure the S&P's performance not against the dollar but against gold, the asset Dalio calls real money, the math looks completely different. The S&P went up 18%, gold went up 65%. Priced the S&P in gold rather than in dollars, and United States stocks lost approximately 28% of their value in real terms. Same index, same year, different measuring stick. negative 28%. And it was not just stocks. Cash lost approximately 39% against gold that year. 10-year Treasury bonds lost roughly 34%. European stocks outperformed United States stocks by 23 percentage points. Emerging markets returned 34%. The rest of the world outperformed America last year, and most American investors missed it entirely, not because they made bad decisions, but because they were reading the scoreboard in the wrong currency. This is the uncomfortable idea at the center of everything Dalio has been saying publicly. If the currency you are measuring your returns in is itself losing value, then what you feel like you made and what you actually preserved are two different numbers. You might be running forward while the ground moves backward underneath you. This is why, alongside gold miners and infrastructure stocks, Dalio has pointed to Treasury inflation-protected securities as one of the safest places to hold income right now. These are bonds whose principal adjusts with inflation. They pay a return above the inflation rate, not just above zero. In a world where the measuring stick is quietly bending, that distinction changes everything. Every move in this portfolio connects back to this single lens. Dalio is not building a portfolio to maximize dollar returns. Is building a portfolio designed to hold real value even if the dollar does not. Now here is something worth sitting with before we go any further, because Dalio has not always been right, and he would be the first to tell you that. In 1982, he stood in front of cameras and publicly predicted an economic depression. He was certain, he had done the analysis, he told his clients, he made the bet, and he was completely wrong. The economy boomed. Markets went up, his clients left, his fund nearly collapsed. He had to borrow $4,000 from his own father just to keep his family afloat. He had a wife and 2 young children, and for a period of time, he genuinely did not know how he was going to support them. That failure did not break him. It rebuilt him. It taught him to stop making predictions and start studying patterns, to look at what has happened across similar situations throughout history instead of betting everything on a single outcome. The big cycle framework, the 40 years of research, the entire methodology behind Bridgewater, all of it traces back to that moment of being catastrophically wrong. So when Dalio says he is not predicting a collapse, he means it precisely. He is saying the conditions that have historically preceded certain outcomes are present. Whether those outcomes arrive on schedule or arrive at all is something no one can know with certainty. He includes himself in that. And that intellectual honesty is worth carrying into how you interpret everything we have covered today. Dalio is not the only one watching these signals, and the convergence of different investors around similar conclusions is itself worth noting. Jamie Dimon has said a recession could arrive in 2026. Larry Fink has reported that most chief executives he speaks with believe they are already in one. Michael Burry, the investor who shorted the housing market before 2008, has built significant positions betting against certain high-profile technology stocks. And Warren Buffett has been sitting on $347 billion in cash while selling equities for 11 consecutive quarters, 11 quarters in a row, 2.5 years of selling. The other side of this argument is real and deserves to be heard honestly. The International Monetary Fund projects positive global growth. Some serious analysts see United States equities moving significantly higher. Goldman Sachs reduced its recession probability estimate substantially from where it stood last year. GDP growth was positive in recent quarter. Earnings grew. The data is genuinely mixed, but here is the one detail that stands out when you survey the entire landscape. Bulls and bears, optimists and skeptics alike. There is one asset that virtually no serious voice is arguing against right now: gold. When people who disagree on almost everything else converge on a single position, that is not noise. That is a signal. So what does all of this mean practically? A quarterly filing is not a shopping list. It is already 45 days old when it becomes public, and it shows one layer of a machine operating across dozens of asset classes at once. The lesson is never to copy the tickers. The lesson is to translate the reasoning. The first idea from Dalio's positioning is to reconsider how you are measuring your returns. If your portfolio gained 18% last year and the asset he calls real money gained 65%, what did you actually preserve? Start measuring what you own against something beyond itself. The second idea is genuine global diversification. European stocks beat United States stocks by 23% last year. Emerging markets returned 34%. Most American investors had zero exposure to either. Dalio has quoted a Chinese proverb on this. The smart rabbit has three holes. Never depend entirely on one place. The third idea is infrastructure over story in technology. If you want exposure to artificial intelligence, own the companies building the hardware it runs on, chips, memory, cloud infrastructure, not the companies priced for a perfect future that has not arrived yet. The fourth idea is the one Dalio has been repeating with increasing urgency for years. A meaningful allocation to gold is not speculation. It is a hedge against holding 100% of your wealth in assets denominated in a currency someone else controls and can expand at will. And the fifth idea is the oldest principle in Dalio's playbook, and the one that matters most when cycles turn. Stay liquid. Do not over-leverage. Do not get forced into selling at the worst possible moment. The biggest opportunities in every crisis across 5 centuries of his research went to the people who had not overextended themselves. They were ready to buy when everyone else was forced out. One economist framed the current moment with unusual precision. He said the economy will probably get through this year without a downturn, but nothing else can go wrong. Like nothing, that is a very narrow margin for error. If Dalio is right, and he has been wrong before, as he will tell you himself, then the assumptions most portfolios are built on deserve to be examined carefully. Not next year. Now. Not out of panic, but out of clarity. The people who navigated every major deleveraging in Dalio's research did not survive by being lucky. They survived by understanding the moment they were actually in, by measuring the right things, by staying in the game when others were forced out. Dalio called it. His portfolio confirmed it. The question now is whether you are reading your own scoreboard in the right currency. If something in this video shifted how you think about what you own, leave a comment below. Tell us which of these 5 moves hit hardest for you. And if there is a part of his current positioning you want us to break down further, tell us that too, because that is exactly where this channel is going next.